Greetings, I'm Andrew Ludwig, and welcome to BLACK ONYX, Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe you, the investor, deserve to be better informed in order to achieve the best risk-adjusted returns. We are speaking to Jacques Conradie, who's the co-portfolio manager of the Peregrine Capital High Growth H4 Qualified Investor Hedge Fund, a long-short strategy that was established in 2000. Jacques, thank you for joining us. Could you give us a bit of detail on your background and how you got into the alternatives?
I've actually got quite a quantitative background. I mean, while at school and university, I represented South Africa at both the International Mathematical Olympiad and the International Computer Programming Olympiad. I then went on to study actuarial science at Stellenbosch University. My first job was at Old Mutual, and I spent about 18 months there working as an actuary while I qualified and finished my exams. But during that time, I started doing the CFA exams, and I actually realized that I had a lot more passion for the content of the CFA exams, and I could really see myself working in investments for the majority of my career. So at that point in time, I made the decision to leave Old Mutual. I guess found the investment work a lot more stimulating than the actuarial side. I looked around, and I think one of the things I was looking for was quite a small dynamic team. I think working at a big company taught me that I think the impact that any individual can have on a company with 30 or 40,000 people is very limited. Where in a smaller company, you can really see the impact you have on the bottom line of the results of the company. So I was lucky enough at that time to find an opportunity as an investment analyst at Peregrine Capital, which was already then the longest running and most successful hedge funds in South Africa, and I joined the business in 2007.
Tell us about Peregrine Capital, its genesis, and some of the strategies that you represent.
Clive Nates and David Fraser founded the business in 1998 after they left Liberty Asset Management, which was at the time one of the largest long-only institutions in South Africa. One of the founding principles of the company, and one of the reasons why they left Liberty to start Peregrine Capital, was they found that in Liberty, or in most of the long-only asset managers, as you progressed and became more senior and a fund manager, you actually end up spending more time with your clients rather than with the actual companies you cover. And all of us in Peregrine Capital are very passionate about researching companies, spending time with management teams. So that I think I was quite lucky to join a business where that was one of the founding principles, that we would always try to spend as much time as possible with the companies we cover. And they also set up the business to run with, at all times, generally 3 or 4 different fund managers. And what this allows us to do is to split the market up between the fund managers so that each of us can still stay very close to the companies we cover. And our end goal really is to make sure that the shares we're invested in, we want to understand them as well and hopefully better than anyone else in the SA market. And I think that's where the edge comes from. On the strategies we manage, we've got 3 broad strategies. We've got a pure hedge fund and a high growth fund, and then a medium risk fund in between. But the core way we run the funds is that any good idea goes across all the mandates, and we simply tailor the risk profile to the type of investors in the strategies. So the pure hedge fund, for example, is a lower risk strategy. It's actually never had a down year in the 20 years that it's been existed, where the high growth fund is potentially higher return, higher vol strategy, where we take bigger bets in the companies we really like. So you'd expect a lot higher returns there, but at the cost of somewhat higher volatility.
Please give me your definition of a hedge fund and an explanation on short selling, and some detail about other ways in which you manage the downside protection and manage these alternative strategies.
Okay, so let's get into just a little bit about what makes hedge funds different from long-only mandates and some of the nuances around it. I would define really as just the key difference is our ability to go short. So whereas a long-only can express his conviction in companies and bet in companies that will do well, I think the hedge fund just gives us the tool where we can actually bet against underperforming companies that we believe will lag the market. Clearly what this allows you to do is then have bigger positions in the companies you like and protect the downside by shorting companies in the same sector that you think will underperform your long ideas. So it effectively gives you a wider range of tools to use to generate alpha for investors. And I think another thing we try to do with our mandates is we want it to be as open as possible. We want to be able to invest in almost any instrument in any country in the world. Not that we continually use that, but occasionally there's been selective, very interesting opportunities in, let's say, SA companies with offshore listed bonds or listed instruments in other markets, and we thrive on those type of opportunities that's hard to find And I guess that's one of the things that makes a hedge fund different, is you can find those selected opportunities that really add some nice alpha to the overall return profile of the fund.
How is your fund different from other mainstream investments and other alternatives out there?
Explaining how our fund is different from competitors and other mainstream products is always a tricky one to do. Our high growth fund, I mean, it's something we're really proud of. For someone that invested 1 million rand in 2000 when the fund started, 18 years later they've now got 80 million rand from that one. So it's compounded about 80 times over that period, and I guess that's really what we want to deliver to investors. And I guess if it was only one or two things that you do differently, our track record wouldn't be as differentiated, and many people would have similar track records, which is clearly not the case. So our belief is that your alpha and your edge over time comes from doing lots of different things consistently right and consistently better than what the industry does. So I'll maybe just try to get into two or three of those. Obviously we can't run through everything, but maybe just two or three of the key differentiators to talk about. So firstly, it all starts with having the right people. Our view is you need to have the smartest people, because I guess it's inherently a competitive industry. You compete with other asset managers, so you need really smart people, but they also need to be driven and motivated, and they need to be passionate about investments. We want everyone on our team on their holidays, when they're lying on the beach, to actually want to read an investment book and stay on top of what's going on in markets. That's what we look for. So I think that's your starting point. You really need to have the staff that want to do it and love their jobs. Secondly, I think we want an inherent degree of skepticism when we analyze companies. So we spend a lot of time with management teams, and I think that's where our edge comes from. And most of the time you can take what they tell you at face value. But there are times when either they don't fully know what's going to happen in their businesses because they can't predict the future, and the economy and the political environment could throw a spanner in the works and affect their results. So you've got to be able to figure out when they're not on top of what's actually going to happen in their own businesses. And then you get the unfortunate rare cases where the management teams are just flat out misrepresenting what's going on or lying to you. And I guess those are the key ones that you've just got to have some sense for, and you've got to pick them out, because those are the ones where you could lose a lot of money, and that could lead to big capital losses if you don't identify those opportunities, or if you don't identify those management teams and avoid those. We also place particular focus on analyzing what we've done well and what mistakes we've made in the past. So every month, every quarter, we look back at what's worked and what's not worked. And I think one of the other things we try to stay focused on is realizing what we're good at and where our competitive advantage lies, and also realizing what we're not good at doing. So I think we're pretty open-minded to say we're not good at everything. We think we're pretty good at finding individual companies that's going to outperform the market over an extended period through good management, through taking market share, through outperforming the industry. And we're quite happy to admit that we're not good at calling the overall market. We're actually really bad at calling the rand-dollar exchange rates, and we can't predict the iron ore price or the oil price. So I think it's a differentiator versus competitors that we're pretty open-minded to say we're clearly not good at some things. Let's not place bets there. We think we are good at other things. Let's focus all our positions and our attention on getting those things right. Perhaps one last thing to mention is that we're quite willing to do a lot of work on complicated situations. So cases where all the information is not yet out there, or it's hard to find the info, or it's a company with a short track record, we're quite happy to dig in there, go see the company's operations, go meet the management team. And I guess that gives us an edge where often we're willing to make a decision on the company either as a good idea or a bad idea before the market. A lot of especially the bigger asset managers, generally want to wait for all the information to be out there and for the investment case to be quite clear. Our view is by the time that happens, the share price already moved. In many cases, in shares we've owned, by the time everyone's figured it out, it's more than doubled. So I guess one of our edges is being willing to dig in there when it's still complicated, when there's still limited information, and make the call earlier than everyone else.